In this lecture, we'll talk about average and marginal costs, knowing what the difference is and knowing which ones to use when making economic decisions. To help motivate this, consider American Express. American Express offers a platinum card to affluent customers, historically defined as those with annual incomes over $100,000. In 2001, there were approximately 2,000 platinum card holders in the Japanese market, and American Express had deliberately limited those numbers to ensure high-quality customer service. With advances in customer service technology, the company was considering an expansion of their platinum program in Japan. And they were interested in knowing how many more customers they should add. On the one hand, as members are acquired, the average spending per member decreases because the financial threshold for membership is lowered, so the profitability goes down. On the other hand, the cost of customer service rises to some level for each additional customer. After analyzing the costs and the benefits, American Express decided that they should expand their offering, but only to 15,000 more Platinum Card members. The purpose of this lecture is to highlight this type of extent decision. An extent decision is a decision that answers the question how much or how many. In this case, American Express was asking how many additional Platinum Card members should we be offering our services to. Knowing the difference between average and marginal costs and which ones to use will help you to answer economic extent decisions. Key idea or the key takeaway points here are: first, do not confuse average and marginal costs. The average cost is simply defined as the total cost, the fixed and variable, divided by the total units produced. So total cost divided by total quantity. The average cost is irrelevant to extent decisions answering the question how much or how many. Instead, the marginal cost is the relevant focal point. The marginal cost is the additional cost of producing and selling one additional unit. This is a key definition. It's a simple definition, but a key one and an important one to memorize. Marginal revenue is defined as the additional revenue gained from selling one more unit. The marginal analysis is very simple but very powerful. From an economic standpoint, a firm should sell more units if the marginal revenue exceeds the marginal cost, and sell less or fewer units if the marginal revenue is less than the marginal cost. If the marginal revenue is equal to the maximum cost, that will typically indicate that the firm is right there at the sweet spot. They're selling just the right amount that maximizes profit. Remember, by definition, marginal revenue is how much extra revenue you get from selling one more unit. Marginal cost is, by definition, the extra cost incurred in selling one more unit. If in selling one more unit you bring in more revenue than it costs you to produce that additional unit, it's profitable to expand your output. And that's the fundamental and simple economic intuition behind the marginal analysis rule. So the relevant costs and benefits of an extent decision are the marginal costs or incremental costs and the marginal or incremental revenue. Again, if marginal revenue exceeds marginal cost, it means that selling one more unit is profitable and you should do it. Now, when we think about incentive compensation schemes, an incentive that increases marginal revenue or decreases an individual's perceived marginal cost will have the tendency to increase effort on the part of the individual to whom that incentive is offered. Fixed fees or fixed payments typically have no effect on effort levels because they do not change either the marginal cost or the marginal revenue of the decision maker. Therefore, compensation contracts that are effectively or well designed will typically link pay to some kind of performance measure that reflects the underlying effort put forth by the decision maker. Let's talk a little bit about average cost. Average cost is the total cost of production divided by the total number of units produced. In formula terms, we'll abbreviate average cost with AC, total cost with TC, and Q will be the common variable that we will use to denote the quantity or number of units produced. Now, it's often the case that average cost will go down as the quantity produced increases. especially if there are fixed costs. To understand this, we simply need to replace TC, the total cost, with its two components, the variable cost plus the fixed cost. Remember, total cost is just variable plus fixed costs. We can see from this lower expression that as Q increases, if fixed costs are constant, it will generally be the case that the average cost per unit goes down, simply because there are more units over which to spread that fixed cost. So fixed cost does not change as Q increases. Now right away, that should be a red flag. If we want to be focusing only on costs that vary with the consequence of an economic decision, and if fixed costs do not vary, then fixed costs, and any measure that includes those fixed costs, such as AC, are not the relevant measure that we should be focused upon. To make this concrete, let's consider the example of the obstetrics department at Memorial Hospital. The department currently has a fixed cost of $1 million, variable costs of $3,000 per delivery, and so at a level of 500 deliveries for the last calendar year, that equated to costs of about $2.5 million. The $1 million fixed cost, and then total variable costs of $3,000 per delivery times 500 deliveries, or a total variable cost of $1.5 million. So the $2.5 million includes the total fixed costs and the total variable costs. The average cost, defined as that total cost divided by the units produced, in this case the number of babies born, equals out to be about $5,000. The $2.5 million divided by 500. Now the obstetrics department at Memorial Hospital was actually producing a financial loss. The marginal revenue for each birth was about $4,300. For 500 births, the total revenue brought in the previous calendar year was about $2.15 million. And we can see then that at a level of 500 births, the unit was running a loss of about $350,000. The CEO was presented a proposal for expanding the obstetric department and questioned whether that was a financially or economically wise decision. After all, the CEO reasoned, why would we want to expand a unit where we're losing money? However, to focus upon the total loss, in this case, is to focus, among other things, on average and total cost, which are not the relevant economic measures. In fact, we could see that if expansion was considered or undertaken, say from 500 to 600 annual births, the average cost would actually decline. In this case, $4,667 would be the average cost, again found by taking the total cost divided by the total number of units. The total cost here, fixed cost of $1 million, plus the total variable costs of $3,000 per unit times 600 units. Divide that total cost by 600, and as you can verify, the average cost is $4,667. Even that average cost is not the relevant focal point, although we can see that as output went from 500 to 600 units, the marginal revenue for each additional birth stayed constant at $4,300. The average cost actually came down. At 600 births, it's not difficult to show that the financial loss would have actually shrunk. And if output were expanded sufficiently far, the profit could actually be turned from a negative to a positive. Economically, the intuition there is each additional birth shrinks that financial loss by $1,300. Why? Each additional birth brings in $4,300 while costing only $3,000. So by actually focusing on marginal revenues and marginal costs, we can see that the marginal revenue does in fact exceed the marginal cost, and it would be profitable or increase profitability to expand output. This average cost curve simply shows what will typically happen to the average cost as the number of units produced increases in the presence of fixed costs. Average costs will tend to go down. Again, the economic intuition for this is that those fixed costs are being spread over more and more units of production, and so the incremental or the average piece of that fixed cost continues to go down on a per unit basis as production increases. The marginal cost, again, is the cost to make and sell one additional unit of output. How do we measure that? The simplest way is to measure the total cost at some level of output, we'll call it Q. The total cost at one additional level of output, we'll call that Q plus 1, and then find the difference. The change in the total cost is attributable to that one additional unit of production. And that simple difference, total cost with Q plus 1 units minus total cost with Q units, is how we calculate the marginal cost or incremental cost of that one additional unit. Often the marginal cost will be lower than the average cost because, as we saw in the last slide, fixed costs will tend to be spread out as output expands, and average costs will tend to be falling with additional output, but that's not always the case. Nevertheless, marginal costs are the relevant cost to focus upon in any extent decision, extent decisions being those that answer the question how much or how many. So the key idea here is to recognize economic extent decisions, decisions that answer the question how much or how many, and anytime you're dealing with an extent decision, to focus in upon the marginal costs and the marginal revenue associated with that economic decision. Thanks for listening.